Hello everyone. Welcome back to Deep Insight with Deepak, where we dive deep into the world of finance and economics. Today we are going to explore a fascinating and crucial topic, behavioral finance. How psychology affect financial decision making. Let's get started. What is behavioral finance? Behavioral finance is a field of study that combines psychology and economics to understand how individuals make financial decisions. Unlike traditional finance, which assumes that people are rational actors always making decisions in their best interest, behavioral finance recognizes that humans are often irrational and influenced by cognitive biases and emotions. The investors and the individuals, they are influenced by the different behavioral aspect like emotions, feeling, attachment that would impact their investment decision making, so that we are going to understand what are the different psychological biases and what are the different emotional aspects that impacted the human being and individual regarding their financial decision making. So there are common psychological biases that we observe in the market. Let's talk about some common psychological biases that can impact our financial decision. The first and foremost psychological bias, that is your overconfidence. Overconfidence in our knowledge and abilities can lead to excessive trading and underestimating risk. This type of bias, that is your overconfidence, leads to the impact factor which we ignore while we are taking such decision. So risk is one of the major factor which impact your return on your investment. So many instances, because of this bias, many people or many individuals, they take the high risk without taking proper financial advice, without understanding the proper financial knowledge. Let's talk about the next type of psychological bias, that is a loss aversion. Loss aversion, that it is a fear of an individual. They always think that they will going to be lose the investment, so that's why they wait for a too long time, or even when they are gaining, so in that case they try to sell the winning investment too quickly. This is usually we see almost 90% of the individual, they took such type of decision, that because of the this psychological bias. The another next type of psychological bias, that is your herd behavior. The tendency to follow the crowd can lead market bubbles and crashes. When everyone is buying, so they feel okay, it's the time to buy. Or when everyone started selling, they feel it's the time to sell. So this is type of individual behavior when they are doing some analysis in the market, and according to the behavior of the buyer and the seller, they used to take the decision. Then the last and the foremost type of psychological biases, that we call as a anchoring. Relying too heavily on the first piece of information we receive, like an initial stock price, can distort our judgment. For example, you are getting some indication through the different perspective from the different source. The source may not be authenticate, may not be recognized. So from that source, we are try to believing that, and then we take the decision accordingly. Let's talk about the different types of example. There is a two basic type of example we have taken into consideration that impacted the whole market in a drastic way over a period of time. So let's illustrate these biases considering the some of the example. Bubble during the late 90s. During the late 90s, the dot com bubble saw investors flocking to take stocks without considering their actual value. And in this type of decision, that we saw the different psychological bias, that is your hard behavior and overconfidence, that leads to a massive market crash when the bubble burst. The second crisis that we saw, that we called it as a global financial crisis, which was started in 2008 and almost ended up in 2014 with the different innovation and different technological upgradation in the financial sector. Loss aversion and overconfidence played significant role in the 2008 financial crisis. Many investors held one to estate investment, hoping for rebound despite clear sign of an impending market collapse. Now, after this, we are going to discuss how to mitigate such type of biases by taking some of the precautions. And we need to understanding our biases is the first step of mitigating their impact on in our financial decision. Here are some of the strategy that would going to be help you to make or to mitigate these biases in your view decision or investment decisions. First is your diversify investment. Diversification is must in your portfolio. Diversification is must according to the your risk appetite that would reduce your risk and minimize the impact of biases on your portfolio. Then you have to set your clear goals. Whatever your goal, the goal may be long term, it may be short term. So you have to focus on your goals. So according to the goal, so you have to take your stepping stone towards your investment decisions. Then seek professional advice. If you are not a professional, so don't take any risk without having any knowledge. So consulting with a financial advisor can provide an objective perspective and help contract your biases. So you can manage your biases taking your professional advice. So the professional advice, it means the people who are recognized and they were authorized to give the professional advice regarding your decision. Don't go with there are n number of people who are available in the market, they don't have any professional knowledge but still they try to earn money. Due to that, they give such type of advice. Then continuous education. So education, that means gaining your knowledge will going to impact your own decision making. So stay informed and educate yourself about behavioral finance to better recognize and manage your biases. So we are come up to the conclusion perspective point of view. So behavioral finance, what it going to help you? It teaches us the art. Our financial decisions are not always rational and can be influenced by various psychological bias. By understanding this bias and adopting strategy to mitigate their effect, we can make better financial decision and achieve our long-term goal. Thank you for watching. If you found this video helpful, please give it a thumbs up, share it with your friends and subscribe to Deep Insight with Deepak for more insightful content on finance and economics. Until next time, stay financial savvy. Thank you.